Hey everyone, welcome to this week's bonus episode of Money Girl with me, your host, Laura Adams. In this show, I answer one of your questions, so keep sending them in. You can ask me about anything related to personal finances, running a small business, being an author, podcaster, or spokesperson. You'll find my contact information at lauradadams.com, or you can leave me a voicemail by calling 302-364-0308. I hope to hear from you and feature your question here soon. Today, I'm going to be covering a question that came in from Pat. Pat says, I just relocated to a suburb of Tampa for a new job and signed a 6-month lease. I have family in the area and would like to eventually buy a home and stay here for the foreseeable future. But I'm unsure how much I can afford and how the mortgage process works. How far in advance should I contact a lender and get pre-approved for a mortgage? Pat, thank you so much for this question, and congratulations on your new job and finding a place where you want to put down some roots. Buying a home is a big commitment, and so it's wise to take your time and get fully prepared before starting your search. So I'm really glad you asked this question. This podcast will answer Pat's question by talking about the benefits of getting a mortgage pre-approval and what to expect when buying a home. Whether you're a first-timer or an experienced homeowner, you'll learn tips to cut the cost of buying real estate and expensive mistakes to avoid. So again, welcome back to Money Girl. This is episode 943. So we have a huge archive of podcasts on just about every financial topic that you can think of. You can learn more, ask questions, and sign up for my newsletter called The Money Stack when you visit lauradadams.com. All right, let's talk about a mortgage pre-approval. Getting a mortgage pre-approval is the first step in forming a relationship with a lender and securing financing for a new home. A pre-approval is when a lender or a mortgage broker reviews all your finances to determine if you qualify for a mortgage, and if you do, how much you might be approved for. A pre-approval also helps you identify any weaknesses in your finances, like, maybe your credit is a little low, or you really don't have enough savings for a sufficient down payment. Anything that could result in a less favorable mortgage offer, you want to know that up front. You want to be able to fix it if possible. And if you do have one or more issues that are preventing you from getting a competitive mortgage offer, postponing homeownership until your finances improve may be a wise decision. So that's really something that you want to talk about with the mortgage lender or broker that you're working with. A lender will typically review your income, your assets, debts, and your credit before issuing you a pre-approval letter. And the letter is going to include the highest home purchase price and the loan amount that they're willing to give you. And it will typically specify if financing is contingent upon the sale of another piece of real estate, such as selling the home that you're currently living in. A mortgage pre-approval typically comes with an expiration date. It might be 60 days or 90 days. However, if you don't find anything, if you don't find a home you want to buy or make an offer on a property that gets accepted before the expiration, it's not the end of the world. You can always get another pre-approval. Having a mortgage pre-approval is important because it shows a real estate agent or a seller that a lending professional has already reviewed your finances, and that you're good to go. It shows that you're a serious buyer and you're looking at homes within the right price range for your budget. And I think buyers with a mortgage pre-approval will have an advantage when, let's say, there's another buyer that does not have a mortgage pre-approval who's bidding on the same property as you. In that case, a buyer with a pre-approval may seem a lot less risky to a seller because their financing is not likely to fall through, wasting precious time. They may even be willing to accept a lower offer from somebody who is pre-approved than somebody who's not. But you should never feel pressured to borrow the full amount that a lender says you can. So just because, a lender says, okay, you're pre-approved to borrow $500,000, that doesn't necessarily mean you need to borrow every penny of that. Remember that before a lender knows the address of a property you're considering, they won't know various expenses associated with that property, like taxes, insurance, and any condo or homeowners association dues. They're just kind of trying to give you a ballpark so you've got a target number when you're out home shopping. Also remember that in certain communities with amenities like a tennis club, golf course, fitness room, pool, boat dock, or beach access, you may have a mandatory membership fee in addition to homeowners association dues. So you want to be sure to factor in all the potential costs when deciding if you can genuinely afford a home. My last home that I purchased, the one I'm in now, cost about half of what my lender's pre-approval was. So I think it is more important to decide the maximum you want to pay per month, inclusive of all homeownership costs, than it is to fixate on a top purchase price that a lender says you can afford. So how do you get a mortgage pre-approval? Well, it all begins by contacting a lender or a mortgage broker, either online or at a local institution. You can work with a bank or a credit union where you're already a customer, or you can start with a completely new company. If you're working with a good real estate agent, they should have some mortgage recommendations. And I recommend getting more than one pre-approval and comparing the loan rates, terms, and fees to make sure you're going to get the best deal. I typically work with a mortgage broker who has a deep understanding of the local housing market. Not only can a broker shop your application with different lenders, but they can also estimate your closing costs more accurately. If they're local, they're really going to know what's customary. Working with a broker allowed me to save about half a percentage point in interest on my last home purchase, the one I'm in now. And over time, that savings can really add up. So be sure to compare a couple of mortgage offers before settling on one. Once you authorize a lender or broker to begin the pre-approval process, they're going to get your permission to review your credit, and they'll ask you to submit or upload a bunch of documents. They want you to prove your identity, so you're going to have to upload a driver's license or perhaps a passport if you don't have a driver's license. They want to prove your employment, so maybe they're going to want to contact somebody in your human resources department at work, or if you're self-employed, they may want 2 to 3 years of tax returns. They're going to want to verify your income if you're employed, like getting 3 months of pay stubs. They also want to know what assets you have. So they're going to ask for 3 months of bank statements and investment accounts like your IRA or 401k. They kind of want to know what savings that you have in brokerages and in retirement accounts. And of course, they're going to want to verify how much you have for a down payment. So again, they're going to want about 3 months of your savings account statements, or maybe a gift letter if you're going to be given any funds for a down payment. So wherever you have all of your assets, whether they're, in a bank, a credit union, brokerage, you're going to want to begin gathering all of that information so that you can easily email it or upload it. Now, Pat asked about the timing for getting a mortgage pre-approval. Since it is typically good for just 60, maybe up to 90 days, you want to wait until you're actually ready to start home shopping before requesting a pre-approval. If you do it too early, it's going to expire and you're going to have to go through the process again and maybe even, submit more bank and financial statements. That's not the end of the world if that does happen, but typically you want to get that that pre-approval started when you're pretty serious that you are going to at least make an offer on a home within 2 to 3 months. And once you do make a purchase offer that a seller accepts, consider what's happening with mortgage rates in the overall economy. Are they trending up? Are they trending down? Lately, they've been trending up a little bit and fluctuating. So in that case, it's best to lock in your rate quickly so you pay as little as possible. So, a lender may allow you to keep a rate locked in for 30, maybe up to 60 days while you work through the contingencies of your contract, like inspections and, getting financing and completing the deal. When my husband and I bought our current home, interest rates were moving down, ever so slightly. So I was not in a hurry to lock in a rate. We kind of wanted to drag it out as long as possible. And I was just able to keep an eye on rates and wait until they weren't likely to decrease any further before I told my lender, yeah, let's go ahead and lock it down. And sure enough, within another day or two, they started creeping back up. So we timed it just right. But, it's pretty impossible to know exactly what's going to happen with rates. You really just have to do your best in getting an estimate with your mortgage broker or your lender. They'll also help you try to determine when the best point is to lock it in. Now, how much pre-approval will you get? This is the big question. And one of the reasons I recommend getting more than one mortgage pre-approval is that every lender evaluates you differently. For instance, some lenders may require a higher credit score, such as 760 or above, to qualify for the lowest interest rate or a larger loan, while other lenders may accept lower credit scores. Your monthly debts, like auto loans, student loans, and minimum credit card payments, are going to be compared to your gross monthly income. This is called your debt-to-income ratio, or DTI for short. The lower your DTI, the better for a potential mortgage pre-approval. And mortgage lenders prefer a DTI typically of 36% or lower for conventional loans, but some will be more flexible than others. And there are some loans that have government backing, like those that come from the Federal Housing Administration, or FHA, and the Veterans Administration, or VA, that will allow DTI ratios as high as 43%. In addition, you can have lower credit scores and even pay as little as 3.5% down for those government-backed unconventional loans. But for conventional loans, those that are just coming through a regular lender, making a larger down payment, such as at least 20% of a home's purchase price, can help you get approved for a larger loan amount and a lower interest rate. Additionally, putting 20% down prevents you from having to pay an extra monthly fee called private mortgage insurance, or PMI. So I always recommend putting down at least 20% when possible, but paying as little as 5% down may be an option depending on your lender. And lenders are required to cancel PMI when you pay down your loan balance to 78% of the property's original value, or you reach the midpoint of your amortization schedule, whichever comes first. And you can also request PMI cancellation when the loan balance reaches 80% of the original value if you're current on your mortgage payment. So, I say that just to let you know PMI doesn't necessarily last forever, but it may last a pretty long time if it takes you a while to increase your equity in the home. And it may be possible to roll some home closing costs into your mortgage, or, to borrow them, or even to negotiate for a seller to pay some of them at closing. However, it's better not to finance them, or to save more than needed so you've got excess cash after buying a home. Being a little bit more conservative is certainly going to be better for your finances in the long run. Now, if you're just exploring the option of home ownership and, you're kind of like, I'm not sure if I'm going to buy or not, getting a mortgage pre-qualification instead of a pre-approval may be the way to go. Now, while those two sound similar, they're totally different in the mortgage world. A mortgage pre-qualification is a quicker assessment of your finances so that you get a rough estimate of what you can afford. You're going to self-report your financial information instead of going through a formal underwriting process where a lender verifies and analyzes your income, debt, savings, and credit. If you get a mortgage pre-qualification, be sure not to make any significant financial decisions or changes. For instance, if you take out a car loan or open new credit cards, that could affect your debt-to-income ratio and your ability to get a mortgage pre-approval later on. Likewise, changes to your income or financial situation after getting a pre-approval could also result in your mortgage application getting denied. So, once you're on track to buy a home, you want to make sure that you really don't do anything with your finances. You want to keep things as boring as possible so that your income is steady, your debt level stays the same, and you don't open any new credit accounts, because any of those changes will throw off the underwriting that the lender has already done, and it could cause them to change their mind about what they offer you. So getting back to Pat's question about how much home you can afford, it really depends on your financial situation and your goals. Many people used to say that it's better to be house rich and cash poor, believing that property will always appreciate. But spending too much of your savings and your monthly income on housing can leave you financially vulnerable and unable to build wealth for the future. It's not uncommon for people to spend 30% of their income on housing. However, I think keeping your total housing costs under 20% is a better target that will give you more financial flexibility. Pat, I hope this has been helpful, and good luck to you as you look for homes in your new city and with your new job. I think this information will also help everybody else, maybe who's struggling or thinking about buying a home right now. And before we go, a quick reminder to subscribe to The Money Stack. That's my Substack newsletter when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or become a paid member with access to live educational events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our fantastic team. Steve Rickyberg audio engineers the show. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. And Nathaniel Hoops is our marketing contractor.